Welcome to Strong Valley, a client-focused independent investment advisory firm. We're glad you're here. Content in this video podcast is for informational purposes only as a service to Strong Valley clients and their guests. Nothing in this podcast should be construed as investment, tax, financial, accounting, or legal advice. We recommend that you speak directly with a financial advisor when making decisions in the context of your specific situation. Investment advisory services are offered through Laura Wealth Advisors Incorporated, a registered investment advisor. Securities offered through Charles & Schwab Incorporated. We hope you enjoy today's mid-quarter roundtable.
Welcome, everyone. Welcome to Strong Valley's first mid-quarter update of 2022. We find ourselves in the midst of tax season getting rolling. Certainly difficult circumstances continue to develop in Ukraine, and inflation's on everyone's mind too, of course. On the other hand, group that COVID has on us, it's been rough for many people. It's getting much looser, and spring is getting close. Although, unlike Paresh, most of us don't have a very harsh winter that we have to look back on at this point. So hopefully those who have not been able to travel or see family and friends get to pick that activity level up. So we're pretty optimistic. And today we have with us Paresh from Amundi Pioneer. Paresh is the Director of Fixed Income and Currency and is a portfolio manager for Amundi. And he just had a little bit of perspective to share with us today, and certainly timely. And so Paresh, I'll let you take it away. Appreciate you being with us.
Great, thank you, Chris. Well, thank you for having us on, having me on. Our weather has been Fresno-like. Just last week we hit almost 70 degrees. The next day we got a foot of snow, which is kind of whiplash weather we're getting here as well. So it's a taste of California. If we had a discussion a week or two ago, what I would be telling you is very different than what I'm telling you now. Previously, one of our key themes that I think the markets are grappling over is concerns about inflation, the fact that it's likely to remain beyond the Fed's target, not just this year, but next year, and a Fed that's behind the curve. Well, over the last 1 week, I'm sure everyone has seen the headlines of Russia invading Ukraine, this potentially becoming a protracted event. I do think that the outcomes for this geopolitical event is actually going to be pretty broad, that I think will weigh on the markets and will ultimately affect monetary policy, economic policy, and the global economy as a whole. So let me start first with the geopolitics. Putin's motivations, what is driving him? It's becoming quite clear that his essay that he wrote last summer, where he talked about restoring Russia's glory, which would mean broadening the federation to include sister states like Belarus and Ukraine. He talked a lot about the historic, cultural ties, religious ties, ethnic ties between Ukraine and Russia, and felt that the disintegration of the Soviet Union in 1991 was one of the biggest geopolitical travesties that Russia has ever gone through, and wanted to correct a wrong. And as a result, he's been sort of putting the pressure, increasing the pressure, and therefore this is something that's very personal, and why I think that Putin's ultimate aims is ultimately regime change, basically replace Zelensky with a Russian puppet. I think that's his ultimate goal, and I think we're going to see how this begins to unfold. Now, whether this becomes a 1 week, 2 week operation, I mean, the early signs point to this becoming more of a protracted event. I think it's definitely beginning to have an impact on European growth, on monetary policy, whether it's the European monetary policy or US policy. The effect of the Russia-Ukraine conflict on global growth is pretty small. When you look at Russia and Ukrainian GDP, both economies are effectively pygmies when you look at it from a broader perspective. Trade, Russian-Ukrainian trade is about 1 to 2% of GDP, so it's a fraction. Therefore, when you look at various scenarios that look at a collapse of trade taking place between Russia, Ukraine, and the world, whether it's Europe, US, and the rest of the world, whether it's looking at the spike in energy prices that we're likely to see. Natural gas prices in Europe are likely to rise over 100% in the coming year. Whether you look at financial conditions that will tighten pretty dramatically, the net impact, the direct impact from all of those factors to global growth is about 0.25%, not a lot. The indirect impact is likely to be a bit more than that, which I would say is no more than 0.5%. Those economies I think are going to be most vulnerable to the Russian-Ukrainian conflict is Eastern Europe, where I think you could see the biggest impact, where you could see the economy weaken by as much as 1%. And then as you go into Western Europe, is probably going to be the second biggest impact. And then finally, US and the rest of the world. I think the impact to the US economy is tiny, between 0.1 to 0.2%, so pretty small. Europe is likely to see an impact of more like 0.3 to 0.4%. But what we're going to see in the interim is uncertainty that is roiling markets. We've already seen equity markets come under a lot of pressure. You've seen US Treasuries begin to rally. 10-year yields have rallied from 2.05% down to 1.71% as of a few minutes ago. And I think that it's indicative of markets expecting the Fed is less likely to tighten as aggressively as previously feared. A week ago, the markets had 7 Fed rate hikes for 2022, and a few more, about 2 more at least for 2023. The markets have since ratcheted down expectations for Fed rate hikes from 7 this year to 5. And then they've pretty much taken out much of next year. So now the market expects the Fed to see the Fed funds rate peak at just below 2%. Now, I think that to me seems kind of low. I know that there is still some uncertainty when it comes to the US economic outlook, but the biggest uncertainty out there for the Fed and for the markets still remain unchanged from before the Russian invasion of Ukraine, and that's inflation. Inflation is clearly out of control. The Fed is targeting a inflation rate of 2%, which is the PCE core measure. That's the measure that the Fed targets. Last week, we got the most recent number, and that was up to 5.2%. That is well above the Fed's target of 2%. And therefore, it will take something dramatic to try to bring inflation back down, since we've moved beyond short-term transitory factors that's leading to higher inflation. It's been reopening up of the US economy because of COVID restrictions that's led to a huge demand for durable goods. It's been supply chain disruptions that's been driving inflation higher, and it's been energy prices. Those are the 3 factors that the Fed has been probably most focused on. Why the Fed believes in its heart of heart that the inflation issue is a short-term transitory issue. I know they've scuttled that word, But it's these three factors that they believe will push inflation back down closer to its 2% target in early 2023. I would point to two factors that I think are lagging indicators that will be more persistent, and that's wages and house prices, house inflation. Those historically have been very sticky. When you look at wage inflation, there is a survey of 8 that I look at, that I'm sure the Fed looks at the same factors, that ask employers, how much do you expect wages to increase for your employers, for your employees in 2022. And those, when you look at those 7 to 10 surveys, on average, it comes out to just shy of 4% wage increase. That's pretty massive. To me, that is symptomatic of the tightest labor market that we've seen in decades in the US. And I don't see that changing. Regardless of what is going on in Eastern Europe, wages is a significant driver behind higher inflation, and not just in 2022, but in 2023. And that's where I think there's a real risk of a wage price spiral. The other is house prices. So you've probably seen, whether it's Case-Shiller, Zillow, Redfin, all pointing to pretty high wage prices. When you look at the calculation of the U.S. inflation basket, they're not taking the Case-Shiller house prices as a plug to the inflation basket. They're effectively looking at rents, and they're assuming if your house is rented, what can you get for your house? And that in my opinion, it underreports what the true inflation rate is for house prices. Because if you remember from the pandemic, as people were fleeing the cities, house prices collapsed. Rents collapsed. And therefore, even though house prices were rising during much of the pandemic, rents were initially falling. And therefore, that decline in rents were being applied to houses in the cities as well as suburbs. Well, now people are returning back to the city, rents are soaring, and as a result, with a lag, house prices will be soaring in the basket. And therefore, I see this as not only an issue in 2022, but in 2023. So what does this mean? The Fed will have to start hiking rates, even though the Fed will talk about and will refer to external events as a source of uncertainty. It will not prevent the Fed from tightening policy starting in March. What has changed from before the Russia-Ukraine conflict is the markets were debating, does the Fed pull the trigger and hike by 50 basis points, or do they hike by 25? And does the Fed hike at every meeting for the rest of the year? I think what's safe to say is that the Russian-Ukrainian conflict completely removes the 50 basis point hike, but that will not stop them from hiking by 25 basis points. I think that they will hike 25. They will talk about uncertainties overseas and the potential impact that could have on the US economy as well as inflation. But if you look at what this conflict does, Russia being a big source of oil, it's about 15% of global oil, and it's about 12% of global gas. It continues to put upward pressure on energy prices. So one of the three factors that I started off with in my sort of introductory remarks was that the Fed believes that energy prices will roll over. But now energy prices, I think, remain elevated. And therefore, the Fed will see that energy prices will remain pretty high. And then throw in the two factors I just mentioned, housing and wages. the Fed will have to pull the trigger. So I'll stop there. I think I spoke for about 10 minutes or so. I'm happy to answer any questions that you might have in terms of what this means, whether it's Fed policy, the US economy, global economy, or even geopolitical events. I'm happy to go into any of those issues in greater detail.
I know Jason had a couple questions, comments also, so I'll let him jump in.
Hey, Paresh, that was great. Thank you. You discussed there for a moment about the 10-year, and we've noticed as well how it was getting scary how fast it climbed. As you mentioned, jumped up to 2.05, and now because of the fears of what's going on in Eastern Europe, now we're back down to 1.7 and change. But we also anticipate, like you said, there's going to be rate hikes this year. The question is how many, whether it's going to be 5, 6, 7, or some other number. Where do you anticipate the 10-year Treasury going? Or do you kind of see the yield curve flattening if we get all these rate hikes, but the 10-year doesn't want to move? Or do you anticipate if we get some resolve in Ukraine, then it may be off to the races?
Yeah, I mean that's a great question, Jason. I mean, something that we debate. We actually had this debate during our weekly strategy call today at 2, and part of that will depend on how long does this issue continue to fester. How much does this cause financial conditions in the U.S. To continue to tighten? Because if financial conditions continue to tighten, it effectively does some of the tightening for the Fed. Until about a week ago, when you looked at high yield credit spreads, when you looked at equity prices, when you looked at the level of the dollar, conditions remained highly stimulative over 2 standard deviations in accommodative territory. And that's the one thing that the Fed was starting to become very nervous about and wanted to start removing some of that liquidity from the markets. If this conflict continues, to carry on for weeks, and if if volatility in markets continue, then you're going to see financial conditions continue to tighten, and the Fed may then begin to sort of back off its rate hikes. If we get to a resolution sooner, or if the markets conclude that this will continue to remain a contained event, between Russia, Ukraine, and the spillover effects aren't really going to go beyond the borders, then you could start to see the markets begin to kind of come back, and therefore markets start to reverse course with 10-year yields, which are right now at 1.7%, back up to 2% and above. If the data continues to be very sticky when it comes to inflation, then I think the markets will continue to expect the Fed to tighten some more. So I think that right now, I think the 10-year yield is probably stuck in a range of 1.7, to 2%. But if things start to settle down sooner than later, I think the markets are going to be quite worried about the outlook for inflation, and will start to price in more rate hikes by the Fed. And we might be back into a 2 to 2.5% range. So what we're recommending to clients is continue to remain underweight the 10-year yield and look for opportunities to expect yields to continue to move higher.
Going off that, if we were to tie in, I've got someone that's curious more if you could elaborate on housing prices. So do you think, you talked about housing prices being rather sticky? If the rate is moving, I understand most mortgages are kind of pegged to the 10-year. So do you think housing prices in the United States are that sensitive to what's going on in Ukraine as it ties into interest rates? How do you kind of foresee real estate prices moving? If you are right, in fact, that let's say the 10-year this year flirts somewhere between 1.7 and 2.25 or something like that, do you still see, or would you expect real estate prices to hold rather steady?
Yeah, I mean, we have a very constructive view on the housing market. The backdrop is the backdrop fundamentals are still very robust for housing. I think what happens in Russia, Ukraine, does affect yields and therefore will affect mortgage yields. But ultimately, I think that the fundamentals driving real estate and house prices, I think is still pretty bullish for housing. The number one driver is household formation. You have if you look at the demographic diagram in the US, the portion of the population with the largest the portion of the age bracket with the largest population is the 30 to 42, 44 bracket. First-time home buyers, that's the largest portion of the US population. They have saved money, whether it's through the pandemic checks, the unemployment benefits, or the savings they built up. They paid off their debt to a certain extent, and mortgage rates remain, historically very low. It wasn't that long ago, back in the early 2000s, where the 30-year mortgage rate was just over 8%. And we're talking about mortgage rates now, having risen, maybe 25, 30 basis points, but historically we're near all-time lows. That's not changing. The other big issue that's supporting house prices beyond demand is inventories. Inventories remain at 30-year lows, and I don't see that changing. Which is, I would love to ask a demographer, what is causing people to stay local? Because that's one thing that we haven't seen going back 100 plus years, where there's a history in this country of people going to where the jobs are, and would move to those cities or those towns. We're not seeing that over the last 10 years or so. The movement has just really fallen off sharply. And I think that's one of the factors why inventories remain low, because people are not putting their house on the market and then moving, let's say, to Austin, from New York or so forth. But that also is one of the reasons that inventories remain pretty low.
I mean, could that also be a technology thing too now? 100 years ago, you had to move to do the job.
Yes, but that's more of a post-COVID era, where because of the pandemic, I know that people were starting to work from home more over the last 10 years than the prior 100. But over the last 2 years, it really has accelerated that pattern. And maybe that's going to be a key driver going forward. But it doesn't explain the last 10 years or so. Maybe it could be an aging population, perhaps.
Neil from Pioneers also joined us. Neil Leahy, who's been a longtime friend of all of us here and supporter of the firm. Neil, did you have anything you wanted to add since I put you on spotlight there?
Yeah, no, I appreciate it, and sorry with my delayed efforts of actually logging in, but I was now coming through the panelists. So, I was, I figured maybe, I was hoping to introduce Paresh. And he's one of the more brilliant minds at our firm, and we all rely on his expertise. But if I have a minute, I'd love to share a little bit about Amundi, who we are, just from a point of reference. I know I've probably met some of the people on this call, although I can't see all your faces. If that's okay, I'll just less of a commercial, more of an introduction. For some, for many of you probably know us as Pioneer Investments, and in 2017 we were acquired by our parent company, Amundi. So for those of you that are unfamiliar with that company, we're one of the largest asset managers in the world. So we're in the top 10 as far as AUM. We are the largest asset manager in Europe. We have offices and clients in over 63 countries, and we manage a little north of 2 trillion. And part of Paresh's team as director in fixed income and in currencies, huge shout out this year, because Barron's rated us as overall the third best mutual fund company in 2021, and taxable bonds #1, and global equity #1. So a lot of this has to do with Paresh and his colleagues and some of the success that we've had, not just of what we've owned, but also of what we haven't owned. So, as we joke around and say, our forecast is mostly sunny with a chance of tornadoes. One of those tornado warnings for many years has been, the Ukraine and the potential for spikes in oil. And here we are, today looking at that right in the face. So I think it's really timely, and I really appreciate Paresh having the opportunity to hear him again and to support strong value. Again, as a leverage partner, it's always a pleasure to represent you guys.
Thank you very much. And I think we're going to just finish it up. Adam, you had, I think, one question you wanted to ask, and then just be respectful of everybody's time and let everybody go at that point.
Yeah, just another client question. Just asking about other global areas that we're watching that may change in the next couple of weeks. I know China and Taiwan is always an issue, and their question more specifically was, what else should we be keeping an eye on that may not be making headlines, or the big headlines currently?
Yeah, so I don't think a lot of conversation about will China seize the opportunity and invade Taiwan. I think that's not likely this year at all. Xi Jinping is looking to be reappointed to a third term in October. And I think he wants to ensure that there is economic stability, there's social stability, there's political stability. And the last thing I think he wants to do is seize Taiwan. I think that will become an issue, but I don't see that as a 2022 issue. It's more of a 2025 year issue and beyond. I would say that in the next 4 weeks, what to keep an eye on beyond Russia, Ukraine, I would keep an eye on the Iranian nuclear talks. If anything, the odds of arriving at some nuclear deal with Iran have probably increased. After all, we are dealing with a shortage of oil, particularly if we start to see the Russians, retaliate by not exporting any oil or gas. That void can be made up to a certain extent, not entirely, with Iran. So this may put, U.S., Iran, and the P5 negotiations with Iran on a fast track to try to get Iranian crude on the market. So I'd keep an eye on that in terms of what's an important potential geopolitical flashpoint within the next 4 weeks.
Paresh, lastly here, curious of your thoughts. What are you most optimistic about? We've talked about a lot of fear, and obviously that's running headlines. But is there anything that you're looking at that you're optimistic at, whether it be valuations or just things that you think might actually end up having a nice year?
Yeah, I mean, while I think the markets are fixated on geopolitical risk, I think it will settle down. And, I'm actually very bullish the U.S. economy. There are some positive structural fundamentals that's driving U.S. From an investment perspective, I'm actually pretty gung-ho about global growth as a whole. A lot of the EM economies have actually begun to reopen, 6 to 12 months after much of the developed markets. And therefore, I think even though we're seeing slower growth in China, and some uncertainty in the near term about global growth, the outlook for emerging markets look pretty good. I expect growth will remain pretty robust this year going into next year. I think for many emerging markets, higher commodity prices actually boost their terms of trade, good for exports, good for domestic growth. And when you look at EM as a whole, whether it's equity or fixed income, it was probably the worst performing market last year. It's very hard to see markets underperform for 2 consecutive years. So I would look at EM markets from an investment perspective and from a global growth perspective, I think will look pretty good. And any slowing that we see in China, I think will finally stabilize during the summer and may actually start to look a little bit more positive, which is another another positive for global growth.
Paresh, I want to thank you very much for your time today and all the timely information regarding the geopolitical risks we've been seeing in Russia and Ukraine, and obviously with interest rates and the talk of the Fed. So I know a lot of that stuff has been on the minds of our clients as they've called in throughout the week, so we've had our meetings. So I appreciate you giving your perspectives and Amundi's perspectives on that, and just kind of ending it as well with a positive outlook, as I think most of us are optimistic that as we get through this volatility that's been triggered from essentially November with the talks of inflation, supply chain, and even the now with the geopolitical risk, that we still are optimistic for the equity markets in the long haul. So I appreciate getting through the noise of the current environment, and also highlighting some of the positive outlooks for the global economy as well as the U.S. economy going forward. So with that, I do thank you for your time and your information, and all of us at Strong Valley thank all of our clients that were able to attend this call, and appreciate you guys hopping on and listening to this, and hope it was insightful and informative for you.
Great. Thank you for having us.
Thank you.
Thanks all.